Hey guys, Chris from adapttuition here, and in this video I'm going to show you how to prepare a purchases or production budget for a period of 3 months. So this is a relatively new addition to the CSEC PoA syllabus. The date of this recording being in May 2021. It was added in 2017 for first examination in May-June 2019. To date, however, it has not yet come on a PoA exam, but I want to make sure you are prepared and know how to do it. So just so you know, this topic can be found in section 11 of the current iteration of the CSEC PoA syllabus, which is accounting for the entrepreneur. Also in that section, you'll find stuff like cash projections, other budgets, business plans, and employees' pay. Now, there is a lot of theory behind budgets and advantages, disadvantages. I don't want to really bog down my video with all of that stuff. Suffice it to say, a budget is a plan. And plans are very important when you are starting business, especially when it comes to resources such as cash or inventory. Because if you don't have enough cash, then, well, as I said in my cash projections video, party done. And if you run out of inventory, things could kind of go bad for you as well. So you want to have a plan to foresee any problems and make plans, therefore, to deal with those issues before they occur. So again, I would invite you to do your own research as to the rationale behind budgets, the advantages, disadvantages. So check your textbook, check the notes your teacher gives you, and of course you could always do some Google research. But please check out credible websites and reliable sources. And with all that said, let's get into the work. Okay, so we are dealing with the purchases or production budget, and this budget shows the number of units that must be purchased or produced to achieve a specific level of sales and or maintain a desired level of closing inventory. This budget is simply a rearrangement of the cost of goods sold section of the trading account. So I have, for easy reference, cost of goods sold here. So your cost of goods sold is your opening stock plus your purchases or production. That gives you your cost of goods available for sale, from which you subtract closing stock to give you cost of goods sold. And of course, the production budget, as I said, is a rearrangement. So you're going to take your goods sold, add your closing stock, which will give you goods available as well, and subtract your opening stock, which will give you purchases or production. Okay guys, so you know me, I don't just like to give formats, I like to explain the logic or the rationale behind them. So this is my explanation as to why the format for this is the way it is. People get into business to make a profit. We make profit by earning revenue, by selling either goods or services, and of course, well, we have expenses. So we have revenue minus expenses profit. But let's go back to the revenue part of it. So we earn revenue by selling goods or providing services. Now, let's focus on goods because we're doing a production or a purchases budget. So we need actual physical goods. So let's assume that we are producing, we are making goods. So let's say on our first month, we say, look, let's make 100 units and see if it sells well. So in your first month, you're going to make 100, and let's assume they all sell out. So you say, okay, good. Whatever my budgeted sales, my target sales, I produced that and I sold everything. Great. Now let's say you figure, well, demand might pick up. So what's going to happen is I'm going to make 120 units for the next month. So you say, okay, that's you're already budgeting. You're already thinking about what do I need for next month, right? You're thinking ahead. That's part of the budgeting process. So you make 120, and let's say you sell 100. So that if you made 120 and you sold 100, you have 20 left. Okay, now you're going to carry that 20 forward to the next month. So let's say you say, okay, look, well, I sold 100. I have 20 left. But you know something? I figure demand might pick up. So I want to have 150 available to sell. And you're like, all right, cool. So if I have 20 now and I want to sell 150, I need 130. So I'm going to need to produce 130. So what did I do there? I took what I wanted to have available, the 150, and I subtracted what I had left in stock, which was the opening stock of 20. So 150 minus 20 is 130. So that's what I'm going to produce now. All right. So what we're seeing there is that whatever number of units we want to have available, right? That's your opening stock plus your purchases, or your production rather. And whatever you have available, one of two things happens with it. You either sell it or you keep it in stock and carry it forward for the next month. So let's just recap that real quick. So you have your desired sales. You also have what you want to have in your closing stock, what you want to have available for the next month. So those two things, right? So that's what you sell and what you'll have left. That's what you want to have available for you. And if you have opening stock, right, in order to know how much you have to produce or purchase, you're going to have to subtract. So to find out what you have to produce, you need to do what? You need to add your sales to your closing stock to find out what you need to have available. And then from that, what you need to do, you need to subtract what you have as opening stock. So sales, or your desired sales plus closing stock, is what you have available minus your closing stock. So that's what you have to purchase or produce. Now, with that said, let's get into the first example. Okay, so let's take a read of this example. Now, it's example 7 because it was part of a larger handout. Don't worry about that. So I want to go forecast that she will sell 8,000 units per month for the first half of 2017. So she says she's going to sell 8,000 units per month for the first half. So Jan to June, okay, as the first half. Her opening stock on Jan 1st is 2,000 units. And she wants to maintain a level of closing stock equal to 20% of the following month's sales. So that is a very interesting piece of information. Pay attention to it. So what do they want? Prepare a production budget for the first quarter of 2017, given the above. So the first quarter is 3 months. A year has 12 months, a quarter of 12 is 3. And the first quarter starts from Jan, then Feb, and ends on March. Well, includes March, okay? So anytime you're heading up a statement, you're doing a statement, head it up properly. Name of the entity, the name of the statement, and the period to which it applies. Also, you're going to put your months, and you're going to put the units, which in this case is, well, units of output or units of goods. Okay. I'm leaving these things here to help us with the format, because again, I know sometimes trying to wrap your brain around the logic behind it could take some time. So I'm making this a little easier for you by putting the line items here. Right? But of course, those are not going to be there for you in an exam. So by the time you get to the exam, you need to understand what you are doing and why you are doing. So you'll be able to know this formula or format offhand. Okay? You can do it. Trust me. Okay. So it starts off with the units sold or the sales volume. So what do we know about the units sold? Right? I want to go forecast that she will sell 8,000 units per month for the first half of 2017. Okay. So we can actually fill in 8,000 units per month here. 8,000, 8,000, 8,000. Cool. Now we know the next step is to add the closing stock, because again, in order to know what you want, how many you have to produce or buy, you need to know what you need to have available. What you have available comprises of two things: how much you plan to sell and how much you plan to have at end. And of course, you'll subtract your opening stock because, well, you'll have some already. Okay, so right, now what does it say here? It says that she wants to maintain a level of closing stock equal to 20% of the following month's sales. So she wants to maintain a level of closing stock equal to 20% of the following month's sales. So in January's closing stock is going to be 20% of the following month's sales. What's the month following January? February. So we need to find 20% of February sales and put that as the closing stock for January. Similarly, we could actually just go across and complete this whole line here instead of going down then going across, but it's up to you, but that's how I'm going to do it. So for February, the closing stock for February would be 20% of the following month's sales. The following month is what? March. 20% of that now is the same 8,000 for the first 6 months. So guess what? The closing stock for the first 6 months would be the same figure as well. Now for March, again, we need 20% of April's sales, but we don't have April's column. But guess what? We don't need April's column. All we need is April's sales. And we know it's 8,000 per month for the first 6 months. Is April part of the first 6 months? Yes, it is. So it's going to be the same 8,000, and the closing stock here is going to be the same 20% of said 8,000. We add those two items together to give us the units available for sale. And since it's the same figures in all 3 months, we're just going to add going down and get 9,600. Now comes an interesting part. So watch me here. Her opening stock on Jan 1st is 2,000. So the opening stock for January is 2,000 units. So we're going to subtract opening stock from the units we want to have. And that's going to give us how many we need to buy. In this case, well, to purchase or produce. All right. So, well, this had a production budget. So let's just say produce. Right. So we need 9,600 because we plan to sell 8,000 and we still want 1,600 left as closing stock. That's a total of 9,600 available. We have 2,000 at start, so we only need 7,600 to be produced. Now, opening stock for February, where's it going to come from? Well, remember, the closing stock of any given month becomes the opening stock of the following month. So here we're going to have 9,600 minus 1,600, giving us 8,000. And again, for March, the opening stock for March, right, comes from where? Right, the closing stock from the previous month. So the closing stock of any given month becomes the opening stock for the next month. So that's going to be 1,600 as well. So that's also going to be 8,000. All right. Okay, so if you have any questions, please leave them in the comment section below. But now I'm going to give you one to try. Okay, let's take a look at it. So let's take a read of the question. So it says, where you want to go wants to sell 10,000 units per month for the first half of 2016. Okay, 10,000 units per month for the first half. Her opening stock on Jan 1st is 4,000 units. All right. And she wants to maintain a level of closing stock equal to 20% of the following month's sales. All right. Prepare a production budget for the first quarter of 2016. Okay, so again, head up properly, name of the entity, name of the statement or your calculation or your budget, and the period to which it applies. Make sure you put the headings for your columns, being the month, and of course the units, in this case, units of goods, right? So again, I left these things here for you all to have some help with, right? So now I'd invite you to take a pause, take a read, try the question on your own, and then unpause to correct. Okay, did you try it? I hope you did. Let's take a look at it. So where you want to go wants to sell 10,000 units, right, for the first half. So her expected sales volume for Jan, Feb, and March would simply be 10,000 units for each month. Now, we add closing stock because, again, in order to find what you need to purchase, you need to know how much you want available. That's comprised of, or that is made up of, two things. How much you want to sell and how much you need as closing stock. So when you add those two together, that gives you the total number of units you want available. And if you have opening stock at start, you could take that away because that means you already have some of those units. So you need the difference to produce or to purchase in order to make up the total that you need. So let's talk about the closing stock now. So closing stock. So she wants to maintain a level of closing stock equal to 20% of the following month's sales. So the closing stock for January would be 20% of February sales. 20% of 10,000 is 2,000. Okay, now that's going to actually take place or happen for each of the next, well, how many ever months? Because each of the following months has the identical level of sales. So for February, the closing stock there needs to be 20% of March's sales. 20% of 10,000 is 2,000. For March, we need 20% of April sales. Whoops, we don't have a column for April. We don't need it because we know every month for the first 6 months of this year, the sales figure is the same, which means that the closing stock will be the same at least up until May. Because in June, we'll need 20% of July sales, which we don't have. But once again, we're not going that far, so you don't have to worry. Right, so all we have to do now to find the units available is to add going down in each column. So I'll put those figures there because they're all the same figure of 12,000. Right, now comes another interesting part, the opening stock. So opening stock at the start of the year is 4,000. So we're going to put that 4,000 in January, and that's going to give us, so if we need 12,000 available, and we already have 4,000, it means that we only need to purchase, or in this case, produce 8,000. Now, what about the opening stock for February? So remember, the closing stock for January becomes the opening stock for February. And 12 minus 2 will give us 10. And what about March? What about the opening stock for March? Well, remember, the closing stock for February, 2,000 becomes the opening stock for the following month, which is March. And 12 minus 2 will give us 10. All right. Okay, so what I'm going to do now is I'm going to switch it up a little bit, and we're going to do a couple more examples. Well, one more example, two more questions that are a little more intense, but you can do it. Let's take a look. All right, so it says Terry Yon will sell 10,000 units in April 2013 and plans to increase sales volume by 10% per month thereafter. Ooh, so here we see the major difference. Sales is not staying static. It's changing. It's increasing by 10% per month. Okay. Her opening stock was 2,000 units, and she plans to maintain closing stock at 20% of the following month's sales. Okay. Prepare her production budget for April, May, and June 2013. All right. So we head up, name of the entity, name of the statement, the period to which it applies, and we put our appropriate column headings. So what do we need? First thing is the unit sold or sales volume. So she will sell 10,000 in April and plans to increase sales volume by 10% per month thereafter. So in April, it's 10,000. Now to find May's sales, we need to increase April's sales by 10%. 10% of 10,000 is 1,000. 10,000 plus 1,000 will give us 11,000. Now, June sales will be 10% more than May's sales. So therefore, we find 10% of 11,000, which is 1,100, and we add it onto 11,000, which will give us 12,100. Right? So again, you're taking 10% of the value of sales in any given month and adding it onto that value to give us the sales for the next month. All right. Now, the closing stock. So closing stock is 20% of the following month's sales. Okay. So for April, closing stock will be 20% of the following month's sales. 20% of 11,000 is 2,200. For May, the closing stock will be 20% of June's sales. So that's going to be 2,420. Now for June, we need 20% of July sales. How do we get July sales? We don't have a July column. We don't have to have a July column, but you probably need to write it down somewhere. So again, we plan to increase sales volume by 10% per month. So what we're going to do, we're going to take 12,100, find 10%. That's going to be 1,210. Then we're going to add it to 12,100, which will give us, I think, 13,310. And then we're going to find 20% of that, which I think is 2662. Yep, there you go, 2662. So again, we found 10% of this, added it on to 12,100. So 10% of that is 1,210. You add it on to 12,100, you're going to get 13,310. Then we find 20% of that. So now we're going to add each of these pairs of items, right? The sales plus the closing stock to find the units available for sale, which is 12,200 in April, 13,420 in May, and 14,762 in June. Opening stock. So opening stock was 2,000 units. So we're going to put that here in April. And 12,002 minus 2,000, I think is 10,002. Right. Now, what about opening stock for May? What have we seen in previous questions? The closing stock from any given month was the opening stock for the following month. So now we could subtract 2,200 from 13,420 to find what we need to produce in May, which is 11,220. And for June, the opening stock there will be the closing stock from May. The closing stock of any month is the opening stock for the following month. So that's going to give us 2,420 there, and subtract that from the 14,762. That's going to give us what we need to produce, which is 12,342. All right. So again, if you need to, just pull the playhead back, rewind if you want to call it that, and look at it again. Jot down your notes. If you're not understanding anything, message me. I'm here to explain. I know I try to explain at my best. Sometimes it doesn't go as I plan, and I know no one explanation will work for everybody. So that's why there's a comment section, right? You can also message me on Instagram at adapttuition. I'll try to get back to you there, but a lot of people message me, and I can't get back to everybody right away. I have a lot of work going on too. Anyhow, sorry. Let me give you guys a question to do. Okay, so this is for CSEC. She plans to sell 25,000 units in April and wants to increase sales volume by 20% per month thereafter. Her opening stock was 5,000 units, and she plans to maintain closing stock at 10% of the following month's sales. Prepare her production budget for April, May, and June 2012. Okay, so head up your statement. Okay, right. So I want you guys to try this one. I almost went into it one time. So take a pause, take a read, try the question, and unpause. Did you try it? How was it? Got a little trouble? It's perfectly normal. If you didn't get trouble, then the things would be too easy. I have to make it harder. All right? Okay. But if you got through it, that's great. That's great. Okay. So first thing is, let's talk about the expected sales volume. So 25,000 in April, and wants to increase by 20% per month. So let's do it one at a time. So in April, 25,000. Now 20% of that is a fifth. A fifth of 25 is 5. 25 plus 5 is 30. 20% of 30 is a fifth of 30, which is 6. 30 plus 6 is 36,000. All right. Now, closing stock. She wants to maintain closing stock at 10% of the following month's sales. So closing stock for April will be 20% of May's sales. 10%, sorry, 10%. So 10% of 30,000 is 3,000, right? For May now, May's closing stock will be 10% of June, and 10% of 36,000 is 3,600. Now for June, we need to find 10% of the following month's sales, which is July. Whoops, how do we find that? Well, we have to scale this up by 20%. So 20% is 1/5, that'll be 7,200. 36,000 plus 7,200 is 43,200. 10% of which is 4,320. So now, to find the units available for sale, because remember, to find out what we have to produce, we need to know how much we need. What we need depends on two things: how much we want to sell and how much we want to have left. The sales volume plus the closing stock. That's going to give us our units available for sale. And of course, we could subtract any opening stock if we have any, because then we wouldn't have to produce what we already have. Okay, so to find units available for sale, we're just going to add going down. So 25 and 3 is 28, 30 and 3,006 is 33,6, and this gives us 40,320. Opening stock. Our opening stock was 5,000 units, so we're going to put that here. 28 minus 5, which means we only have to produce 23,000 in April. Now in May, where is that opening stock going to come from? The closing stock from any month is the opening stock for the following month, sorry. So the closing stock for April is the opening stock for May, which is 3,000 here. And it means therefore in May, we only have to produce 30,600. The closing stock for May becomes the opening stock for June. And we subtract those two items to get 36,720. All right, so how did it go? You think you need to try one more? All right, let's try the next one. Okay, so this is Jamie. Jamie plans to sell 12,500 units in April 2016 and wants to increase sales volume by 20% per month. Okay. His opening stock was 2,500. He plans to maintain closing stock at 10% of the following month's sales. They want a production budget for April, May, and June. Okay, so take a pause, take a read, try the question, unpause. How did it go? Was it a little better? Got some trouble with the percentages for the growth? That's okay. Let's take a look at the question. So please remember to head up your statements properly. Make sure your columns have the appropriate headings as well. So let's go. So we need expected sales volume. So Jamie plans to sell 12,500 units in April 2016. So let's put April first, right? Boom. Then he wants to increase by 20% per month. So 20% is a fifth. A fifth of 12,500 is 2,500. 12,500 plus 2,500 will give us 15,000. 20% of that is a fifth. A fifth of that is 3,000. 15 plus 3 will give us 18,000. Okay, good. Closing stock. Now, closing stock is 10% of the following month's sales. So the closing stock for April is 10% of May's sales. 10% of 15,000 is 1,500. Okay. Closing stock for May is 10% of June's sale. 10% of 18,000 is 1,800. Closing stock for June is 10% of July's sale. All right, how do we find July? Well, we have to increase June's sales by 20%. 20% of 18,000 is 3,600. Added to 18,000 will give us 21,600. 10% of which is 2,160. Right. Now, what we'll do is we'll simply add going down, because that'll give us the units available for sale. Because remember, we're looking for how much we have to produce. How much do we want to make? Well, how much do we need? Well, we want this many in sales. We also want to have some left over for the next month. So we add those two to get the total that we want to have available. And we happen to have some in opening stock. So we could subtract that from the total we want to find the remainder that we need to produce or purchase if that's the case. Okay, so all we have to do is add. So we're going to add going up. Well, add going down. So I'm filling all three at the same time. 12,500 plus 1,500 is 14,000. 15,000 plus 1,800 is 16,008. 18,000 plus 21,600 is 20,160. Opening stock time. So opening stock in April is 2,500. So we're going to put that here, and we're going to subtract 2,500 from 14,000 to give us 11,500. So that's how much we have to produce, because again, we needed 14,000 in total. We already had 2,500. So we only need to produce 11,500. Next, the closing stock from April becomes the opening stock for May. So we're going to subtract that from the units available, or units required, I suppose you could put, and we're going to get what we had to produce. And then the closing stock for May becomes the opening stock for June. And the opening stock taken away from the units available will give us the units required for production. Okay, so there you have it, folks. That is how you prepare a production or a purchases budget. So if you have any questions, again, please leave them in the comment section below. If you want to check out more budgeting videos, I'm going to put some cards up here. Don't forget to subscribe and click the notification bell so you know every time I drop a new video. Check out my website for some free PoA handouts. And as per usual, guys, thank you very much for watching. Take care of yourself, stay safe, and I'll see you next time. Bye.